Okay, so welcome to our second video. In our last video, we talked about the income statement and the balance sheet, and basically what goes into creating all of those statements. And this time, we're going to go into the statement of cash flows, and that's really going to give us our foundation of the three main financial statements. And, we're going to talk about how to connect them together. And so in order to get an understanding of the statement of cash flows, we first need to understand why do we even need it, right? We have the income statement, right? The income statement tells us that we have income coming in, right? We need to know how much income we have, right? The balance sheet tells us our assets versus our liabilities, right? So why do we need a statement of cash flows? Right? Why is it really necessary? We have the income statement that tells us our income. We have our balance sheet, which tells us the assets and liabilities. Why do we need the statement of cash flows? And if you think about it, you'll realize that the income statement tells you your income for taxable purposes. If you remember, when we said what is needed in order to go onto the income statement, we said it has to relate to the current period and it has to be tax deductible, with the exception of revenue, right? And if that's the case, right, there is taxable income which you don't have in cash. I'll give you an example, right? If you earn revenue because someone paid an account, right, that's revenue that the firm has. It goes into your accounts receivable. You don't have the cash yet. You still have to pay taxes on it, right? Because it relates to the current period and it's real revenue. And so there are lots of things in the income statement which have to do with real revenue and real expenses, which are not cash expenses, right? They're not always, sometimes they are, but the income statement does not necessarily equal cash going to or from the firm, right? So what we need is a statement of cash flows to basically convert the income statement into whether or not cash goes up or down for the firm. And so what we do with the statement of cash flows is we're going to start with net income, and we're basically going to make adjustments to net income, which should give us the total amount of cash that goes up or down for the firm. Sounds simple enough. So how do we do that? Well, first, we're really going to need to understand what cash flow is, right? So before we build out a full statement of cash flows, we're going to talk about defining what free cash flow is, because that's the very simple first understanding, and from there we'll build out the entire statement of cash flows. So free cash flow is basically once the firm has paid, and we'll talk about the difference for those of you who know between levered and unlevered free cash flow. We'll talk about those differences soon. But for levered and unlevered free cash flow, right? Levered free cash flow is what we're going to be talking about now, but that's not really important. But basically, free cash flow says that's free cash flow. Okay, free cash flow says, listen, the firm has a bunch of money going out and a bunch of money coming in. A bunch of cash going in and a bunch of cash going out. Some of that cash is in terms of, different things that they purchase. Some of that is in terms of people paying off their accounts payable. Some of it is in terms of CapEx. We're going to talk about all of that. But basically what free cash flow does is it takes our estimate for the cash coming and going to the firm, and we make some adjustments to get a much better estimate. Okay, but it's still an estimate. It's not the full statement of cash flows. So how is this really calculated? So traditionally, free cash flow equals EBIT, which is something we talked about in our last video. Earnings before interest and taxes. And we're going to make adjustments to this. So why would we say earnings before interest and taxes? Well, because if you think about it, right? Well, actually, it shouldn't be. That's why I'll explain that in a second, but that's why we actually multiply it by 1 minus the tax rate. Because what we want to do here is we're taking EBIT, which comes from our income statement, right? EBIT comes from the income statement. And what we're doing is we're saying, look, our earnings before our interest and taxes are going to be pretty closely correlated with our cash balances. We know it's not going to be perfect because of things like CapEx, because of things like depreciation, which can go on an income statement but has nothing to do with cash. These are all things, that's an example of something we call a non-cash expense, which is precisely what finding out free cash flow is supposed to help us adjust for. But basically, we're going to say, listen, our earnings before our interest and taxes is a good estimate for how much cash has gone in and out of the firm. But wait, we actually have to pay taxes. That's a cash expense. So let's adjust for taxes, right? So earnings before interest and taxes, we cross out taxes by multiplying by 1 minus the tax rate, right? So now, I'm just going to get rid of that so it's easier to read. So we have EBIT times 1 minus the tax rate. Now what else do we want to do? Well, we spoke about depreciation, which is a non-cash expense. So for those of you who remember, depreciation is a non-cash expense, which is deducted on the income statement. Now, why is it deducted on the income statement? Because remember, it relates to the current period and it's tax deductible. We talked about this at length in our last video. So because of those two things, even though depreciation is not a cash expense, it still brought down our EBITDA, or our EBIT. So what does that mean? We need to adjust by bringing it up in equal amount. So how do we do that? Very simple. All we do is we add depreciation. I'm sorry, my handwriting's awful here. But here, all we do is we add depreciation. Okay, let me fix that handwriting just a teeny bit. So basically, in order to balance out the weight that depreciation has put down on EBIT, because remember, depreciation reduced EBIT, and we're trying to find free cash flow. So if we're trying to find the amount of cash that's coming and leaving the firm, we're using EBIT as our base and making adjustments to that. So the first adjustment we have to make, right, is we say, listen, taxes are a cash payment, but aside from that, we need to add back depreciation. Why? Because it's a non-cash expense that was a weight down on our EBITDA, so we need to add it back. Because we didn't actually lose any cash, we just wrote it off for tax purposes. A good way to think about this is the income statement is what you need for tax purposes, but the statement of cash flows is what you need for operating purposes. Meaning, if you're short on cash, you have what's called a liquidity problem. A liquidity problem, right? What's a liquidity problem? Liquidity is basically how quickly, liquidity literally means how quickly can you access your assets. But what it means in this case is if you have a liquidity problem, it means when it comes to cash flow, it means you don't have enough cash on hand. You might be income statement rich, which means you have to pay a lot of taxes. But if you don't have cash on hand, you physically can't run your business, right? Businesses need cash to operate. And inversely, you could have taxable income of almost zero, right? You could, for example, deduct so many expenses because you're in a business with huge capex, for example, that has tons of depreciation. And because of that, you would have almost no taxable income, but you could have tons of cash on the sidelines. So management needs to know that. So for tax purposes, that's what the income statement's for. But management needs to understand where the cash is. So that's really why we need to understand free cash flow. So here, so we do EBIT, we realize that we have to pay taxes, that's a cash expense, so we times 1 minus the tax rate, right? So our earnings before interest and taxes, now we just have our earnings before interest, right? Then we add depreciation, because depreciation was a weight down on our EBIT, so we're making that adjustment by adding it back because it's what we call a non-cash expense. And then what we have to do is we say, listen, where does depreciation come from? Right? Depreciation doesn't come out of nowhere. It comes from capex. And what's capex? A capital expenditure is an expense, usually a pretty big one, that's good for more than 1 year's time. So it doesn't reflect to the current balance sheet. Remember, we said depreciation is the portion of capex that refers to that current time period. So that means capex is a real cash expense, was never accounted for on the income statement. And if that's the case, we need to add it back. Because we need to realize, or we need to subtract it, because we need to realize that capex is a real, depreciation is a non-cash expense that's on the income statement, but capex is the opposite. It's a real cash expense that we totally didn't put on the income statement. So we need to realize that we lost cash. So we need to subtract capex. And subtracting capex here and adding depreciation makes adjustments for the things on the income statement and not on the income statement, which we really need to focus on here. But there's one other thing we need to do, right? Because there's something called net working capital. Net working capital, here, let me start over here. Try this down for you guys here. Net working capital, okay? net working capital, that's two words, not networking like you're networking, but net working capital, okay, that's equal to current, I'll tell you what it is conceptually first. Net working capital conceptually is the amount of money that a business has to run its day-to-day obligations. Because if you remember, we just said that we care about free cash flow for management purposes, to know how much cash do we have in the business, right? So what is this then? Why do we really need to know what net working capital is? Because net working capital tells management, look, here's how much money we have on hand to handle our current liabilities, our current obligations. And so this is calculated by simply doing, look, we want to find our current assets, and we want to subtract it by our current liabilities. Sorry for the sucky handwriting. That's it. All we say is current assets minus current liabilities. That's equal to net working capital. Now you say, what is a current asset? What's a current liability? So there's a little debate on that, but most people say that current assets are usually defined as things which can be accessed either very quickly, like cash or cash equivalents, or they say it's something that can be accessed within 12 months. And the current liability is the inverse of that. So basically, things that need to be paid on a rolling basis. So current assets are, cash that we have on hand. It's very current. You know what I mean? But if you have it locked up in a long-term CD, you can't really access it. So it can't really help you pay your current expenses. So one way to conceptually look at this is to say, look, right? Your current assets are anything which can help you pay your current liabilities. And your current liabilities are anything which you need to pay on an ongoing basis. Current assets are the assets you have which help you pay those current liabilities. So that's conceptually how you look at it. Okay, so how does this affect the free cash flow? Well, think of it this way. If your net working capital were to go down, what would that mean? If net working capital were to go down, that means you have a higher current liabilities. That looks like I wrote current assets are higher. So let me undo that. Here, you have a higher current liabilities. And if you have a higher current liabilities, what does that mean? Right? It means you have less cash on hand. So what we need to do is we need to subtract the change. We need to subtract the change, or that triangle there is the Greek letter delta, for those of you who don't know. And delta just means the change. So we have to subtract the change in net working capital. Right? Because if net working capital goes down, right, that means you lose cash, right? And does that make sense? If net working capital goes down, it means you lose cash. No, if net working capital goes down, it means current liabilities have gone up or current assets have gone down. You subtract the change in net working capital. Let me think this through again. Give me 1 second. And this sometimes happens. It's okay to, not know everything right away and to have to look at it a little and, figure it out. To subtract the change in net working capital, why do we do that again? Because, for example, if your net working capital goes up, right, that means that you have more money tied up in current... Oh, okay. Basically, here's what it is. Ignore those arrows I just drew. Ignore those arrows I just drew over there. Here, we still subtract the change in net working capital. But why? We do that because if net working capital goes up, that means there's more money tied into running the current operations of the business, which for management purposes, we say reduces free cash flow. Why is that? Because if we have more net working capital, that basically means more of the funds are tied up into running the business by funding its current liabilities and stuff. Right? So if net working capital were to go down, that would mean you have minus a negative here, which is plus a positive, right? And if you have plus a positive, that basically means that cash flow has gone up. Because basically we're basically siphoning off net working capital and saying, look, we need this to fund the very short-term, nature of the business. And if that goes down, then more money is tied up into that, or then less money is tied up in it. And if it goes up, then more money is tied up in it, so it's less free cash flow. I hope that made sense. If not, feel free to text me. So yeah, so that's free cash flow. So this is the most basic estimate for free cash flow, and this is kind of the foundation for our statement of cash flows. So I don't want these videos to be too long anymore. I don't want to do so many more 40-minute videos, so I'm going to try and stop in the next 5 to 10 minutes. But basically, right now we're going to go over the difference between levered free cash flow versus, not W, that should be a V, versus unlevered free cash flow. Okay? Or unlevered free cash flow is also called cash flow to the firm. Okay? Levered free cash flow is what we're looking at right now. Okay? Levered free cash flow is the amount of cash a business has after it's met its financial obligations. Right? That basically means we say, really the difference here is, how should I put this? Okay, basically, here's how I should explain this, just because we haven't explained the concepts of levered and unlevered that much yet. So I don't want to just talk about free cash flow. I want to introduce levered and unlevered also. Okay, unlevered basically means without taking debt into consideration. Levered means with taking debt into consideration. Okay? So unlevered free cash flow basically says, look, we want to find out, right? We want to find out what happens before interest is taken into account, right? So unlevered free cash flow is before interest, because interest is basically what the income statement works with debt, right? The income statement works with debt by calling it interest, because that's the current portion of the long-term debt, right? A comparison for that would be just like depreciation is the current portion of your capital expenditures, the interest is your current portion of your long-term debt, right? And this actually makes a lot of sense, because if you think about it, debt and capital expenditures are really two sides of the same coin. One is long-term investments, one is long-term borrowing, but the other person's long-term borrowing, right? But one side is investing, one side is taking on debt, which is someone else's investment. So they're really two sides of the same coin, right? So basically here, unlevered free cash flow, that's what we just calculated, because it's before interest. Now, if we wanted to find levered free cash flow, right? And why is this called unlevered free cash flow? Another reason to think of it is because this is basically gives us the free cash flow which can be paid off to everyone who has an interest in the company, right? Think of it this way. Free cash flow, yes, it's used for management purposes, but it's also used for another purpose. What other purpose is it used for? It could also be used to pay out dividends to shareholders. It could also be used to pay off debt. And if you think about it, debt and equity, they're two different types of owners of the same company, right? We always think that equity owns the company, debt is just lending to the company. But if you think about it, there are different types of ownership, but they're both ownership. Why is it? Because they both have a claim to the company's assets, right? That's really what owning something means, right? If you have a claim to the company's assets, you are, in a sense, an owner of the asset. And so looking at unlevered free cash flow, you're saying, look, we don't want to take debt into account because our debt shareholders have access to our free cash flow also. So unlevered free cash flow says, look, how much money is available to everyone who has a financial interest in the firm, whether it's equity or debt. Levered free cash flow says, listen, right? We have financial obligations to pay off our debt. We don't have financial obligations to pay off to our equity shareholders, right? It's not an obligation. Maybe it's expected, but it's not an obligation. Like, for example, an equity shareholder can't take them to court to say, listen, why aren't you paying off, your dividend? They're not guaranteed anything. We're not talking about preferred stock here. We're talking about common stock, right? Common stock isn't guaranteed a dividend. But, debt can be, bondholders, they can be guaranteed a coupon payment. And so there's a financial obligation the company has to pay off one type of stakeholder, but not to pay off another type of stakeholder. So the company might draw a distinction and say, okay, listen, we want to know how much money we have or how much cash we have to pay off the entire firm, which includes debt and equity holders. But we might also want to know how much money, so this one right here, we could say is debt plus equity shareholders, right? But we also want to know how much money do we have to pay out dividends to the people we don't have financial obligations to. Meaning, listen, our cash actually goes down by paying off the debt holders, which we have to pay off. So what's left for the equity shareholders? And that is what's called levered free cash flow. Basically, you already take into account the effects of debt and figure out how much money do you have that you can pay off to the debt or to the equity shareholders, which is why levered free cash flow is sometimes called free cash flow to equity. It's also sometimes called, it's also called free cash flow to equity. Okay, so now if we were to go to undo all this, if you still need it, go back in the recording, but I just want to clear some space. One sec. There's got to be a quicker way to do this. There we go. Sorry, one sec. Okay, so let's talk about levered free cash flow now. Okay, and then we're going to start off with our statement of cash flows, and then in our next video, we're actually going to go deep into the statement of cash flows, and we're going to figure out how the three statements connect with each other. Okay, so levered free cash flow. Levered free cash flow, one second. Sorry, this pen isn't working right now. Yeah, levered free cash flow. Is this working? Here, now it is. Okay, levered free cash flow, remember, is what's left to pay off to the equity shareholders, right? So what would we think could be paid off to equity shareholders, right? We know that that has to be after interest. So if with unlevered free cash flow, we started by taking EBIT, and we took, that's terrible. That's supposed to say EBIT, not EBI. Okay, if it says EBIT, right, times 1 minus the tax rate to get rid of T, right? So what that does is it gives us earnings before interest. Here, we want earnings after interest. What's another word for earnings after interest? Net income. Exactly, net income. Look at that. So what we care about here is much less EBIT adjusted for taxes, which basically just gives us our earnings before interest. What we care about here is our net income, right? Because net income is something that's not payable to debt holders because we already took into account what we pay for debt holders. For debt stakeholders, not shareholders, for debt stakeholders, we pay out interest. We don't pay out dividends. We don't pay out from the net income. So net income, we can just take that right from the income statement. We can start with net income when calculating levered free cash flow. So it equals net income. Again, we have to add for depreciation because that's a non-cash expense that we had on the balance sheet, right? Again, and when I say we have to add depreciation, that also means amortization. For those of you who don't know, I don't recall if we spoke about this in our last video, but depreciation and amortization are basically, they're also two sides of the same coin. Depreciation is usually for what's called a tangible asset, and amortization is an intangible asset. But aside from that, there's the same thing. I'll give you an example. Depreciation would be with a car. It depreciates over what's called the useful life of the car. We definitely spoke about this in our last video. That's around 5 years. So every year you can write off, assuming straight line depreciation, which we mentioned last time also, you can write off about 20% of a car. However, right, depreciation here is for something physical. But if you have, for example, a patent that's good for 20 more years before everyone else can copy you, right? You can actually write off the value of that patent as if it were depreciating. Except because a patent is intangible, intangible is just a fancy way for saying it's not like a thing. Like a patent is virtual. It's not like a physical thing. They might send you a certificate, but you get the point, right? A car is a physical thing you use that loses value over time, right? A patent is like it's like a concept. It's like, it's esoteric in a way, right? And so basically a tangible asset just means it's a thing. An intangible asset means it's like intellectual property or something like that. Something that's real, that loses value over time, but it's not a thing. You know what I mean? So you want to add depreciation and amortization, and that goes with unlevered free cash flow also. When I say add depreciation, that means also add amortization. Conceptually, they're the same thing. There's just a different word for that little distinction. And then again, you want to subtract your capital expenditures for the same reason last time. It's a real cash expense that you didn't account for in the income statement. You also want to subtract your change in net working capital for the same reason last time, because that money is tied up in running the business in the short term. And you also, and here's the only other difference, want to subtract your mandatory debt repayments. So mandatory debt repayments, here, mandatory debt repayments. Why do you want to subtract mandatory debt repayments? Because, and again, here we're not talking about interest payments, we're talking about mandatory debt repayments. So we're talking about paying off principal. Why? Because by virtue of taking net income instead of EBIT, right, we've already accounted for interest here. So we've already accounted for that by taking net income instead of EBIT. So now all we have to take into account when it comes to debt is the mandatory debt repayments. So this is levered free cash flow, and this gives us how much free cash flow do we have to the equity stakeholders in the firm. Unlevered free cash flow, which is what we calculated last time, is just to the firm and to all the stakeholders in the firm, whether it be debt or equity. Okay? And so the difference here is basically, instead of EBIT times 1 minus the tax rate, we use net income. And instead of just stopping after subtracting net working capital, we also subtract mandatory debt repayments. But aside from that, the formula is the same as unlevered free cash flow. And that's where we're going to stop with this. And I'll see you in the next recording to go over how we get from this to our, lengthy statement of cash flows.